Every other day, there's a new housing prediction or a new article stating how there's a housing crash coming, which is ironic because these predictions are becoming pretty much worthless, just like they claim that it's going to happen to home values. Today, I want to talk about why the housing crash of 2021 never came to fruition like a lot of people predicted, and why it still could potentially happen. And at the very least, we want to cover why it's going to be significantly different than the 2008 financial crisis. Now, just a brief introduction. My name is Larry. I spent years as an accountant, auditor, as well as a financial analyst. I love personal finance and real estate, and as well as making videos regarding small businesses. And if those are things that interest you, please consider subscribing to the channel. I'm almost at 1,000 subscribers. Now let's jump into the video. Now first, I feel like I need to start where the real estate market currently is in terms of home value. In general, we're seeing record-breaking prices in terms of the sales price of a home in various states, and this is largely driven due to low inventory. There's only so many homes available on the market right now, and people are buying it up. Some of these homes are only staying on the market for a few days, if that at all. Sometimes it's sold on the very first day that it's put on the market. And because there's a significant amount of buyers buying up this relatively low inventory of homes, then people begin to outbid each other, and that's how real estate prices get driven up. Now, there's actually a variety of reasons as to why the demand for real estate has been so strong lately. There's three main reasons that I want to cover in this video. The first being low interest rates. When there's lower interest rates, people tend to buy more house. People that weren't on the market for a home end up buying a house more affordable. Just think about it this way. If you were to buy a $200,000 home at, let's just say, 5% interest rate, if that interest rate to drop to 1%, you probably would end up thinking that you could afford a bigger home. So you end up favoring a $300,000 house. So that's kind of how interest rates, all else being equal, that interest rates, the lower it goes, the higher the real estate prices end up being. I'll also come back to interest rates in a bit to kind of talk about how I think this is going to be a key indicator on deciding whether or not real estate prices are going to collapse in sometime in the near future or not. Now, the other two reasons I wanted to cover as far as why real estate demand has been so strong has to do with the fact that people value their homes a lot more nowadays, especially when you're working from home. You care about an updated kitchen, an updated bathroom. Those are things you value. And perhaps if you're living in an older home, maybe the easy route is just to buy a bigger house or move into a newer home. The other reason has to do with the fact that home values have appreciated in a lot of key areas. So given this fact that, you bought a home at $200,000, but now you can sell it for $250,000, that's $50,000 of profit that you only end up realizing if you were to sell the home. Now, most people end up taking that $50,000 and just end up buying a bigger home, so it doesn't really benefit them that much. But the point remains that most people are moving to a different home, especially in this key area of about $200,000 to $500,000. That's where you're seeing the most appreciation, which also means this is going to be the most likely and most at risk for home values collapsing in that key area. Now, I do want to go back to this point about record-breaking sales price in terms of real estate, because I feel like most people end up seeing that, and then it causes this worry that sometime soon after these record-breaking prices that the real estate market's going to collapse. And now I'm just making a generalization here, but I do want to point out that the normal trajectory of most things like the stock market, GDP, just due to inflation is to go up. I'm not necessarily saying things can only go up or that stocks or stonks can only go up, but the reality is that most things tend to go up, meaning that every other day is a record-breaking price, right? I can make the argument that every single day you're at a record age, right? Every day you're older than the previous day. The same is kind of true with real estate prices. If it's always continuously going up over the long term, then you can expect that there's always going to be record-breaking prices, but that's just due to keeping up with inflation. Now, if you want to compare inflation compared to real estate prices and how fast real estate prices have appreciated, that's a better argument that you can make. Now, we'll cover that towards the end of this video, but the whole reason I bring up this concept of record-breaking prices is because a lot of people use record-breaking prices as an indicator or a prediction as to why real estate markets are going to collapse. If you just think about from 2008 to 2020, every single year we had record-breaking asset values in terms of real estate market or as well as stocks, and every single year people made this continuous prediction that we can't continue to go up, that we've never had a growth period this long, so that's why there's going to be a recession sometime in the short horizon. But the reality is that never came to fruition, and what did come to fruition in 2020, nobody could have accurately predicted. And so the same could be said here, that just because we're having record real estate prices right now is not necessarily an indicator as to a real estate collapse coming soon. So how can we accurately predict when real estate prices are going to collapse? Well, when it's happening, I'll be sure to tell you. Okay, obviously I'm joking there, but the reality is no one can 100% accurately predict when a real estate collapse is going to happen, because if you could stand to make a lot of money. You would keep a lot of value in cash, so that way once real estate prices collapse, you can buy up cheap property. Now here's the catch. The problem is that there's an opportunity cost to holding cash rather than taking that money and investing it elsewhere, such as the stock market or various other assets. If in March of 2020 you had told me not to invest my money, not to take my cash and invest it in the stock market, and just to keep it in cash so that way I'm ready to buy up cheap real estate, in retrospect, that would have been a very bad move. You would have been better off just taking all that cash and investing into the stock market. This is why I always find it funny when you see people making comments or bragging about how they're ready for the next recession and that they're going to buy up all this cheap real estate, and that's why they're holding cash because they're so eager to buy up cheap real estate, just like in 2008. Well, the reality is they are losing out in the short run because they're not investing in the stock market or various other assets that would gain value. Plus, there are two major flaws when it comes to real estate predictions. The first is that given enough time, somebody has to be right in terms of his real estate predictions, and it's not necessarily because they have some kind of accurate financial model that can accurately predict real estate prices. The reality is given enough time, if every single month, every single year, somebody is making a prediction that the real estate market is going to collapse, at some point, they're going to actually accurately predict when the real estate market collapses, but it has nothing to do with their financial model. It just more has to do with the fact that they just continuously predicted that it would collapse. The second thing to be aware of is that fear sells. When it comes to financial predictions, especially with real estate markets, you perk up a lot more ears and eyes when you make fear-based predictions. If I say you stand to make $1,000 if you take this advice, that sounds great and all, but if I say, hey, if you don't take this financial advice, you stand to lose $1,000, that's going to raise a lot more attention and awareness. The same is true with real estate predictions. A lot of people make real estate collapse predictions because it's a lot more fear-based and it grabs a lot more attention, just like this video in a way. And if I were to make a prediction about how real estate prices are going to increase and appreciate 10% in the next year, that's probably not as interesting of a video to most people. This whole concept has to do with loss aversion, which I made a whole separate video on that topic as well. But if you've ever wondered why it seems like when the real estate market or even the stock market just decreases even slightly, you're listening to a podcast and they just continuously run these ads regarding gold, silver, it's the only safe asset. That is the whole concept right there. They're selling this fear-based idea. If I just told you that gold appreciates by 10% every single year, that sounds great. But if I tell you that, if the real estate market or if the stock market crashes, you're going to lose all your wealth, but if you invested in gold, that's the only safe way to keep things away from this fear-based idea that I'm trying to sell, then you're more likely to buy gold or buy silver. The reality is there's only been one thing that's ever been proven to get rid of financial risk in terms of losing your wealth, and that's to subscribe to this channel. Okay, obviously I'm joking there and just trying to be smart. The reality is diversification has been proven countless times to make sure that you're diversifying this risk and that you're not necessarily putting all your wealth and eggs into one basket, so to speak. When it comes to the real estate market and a potential real estate collapse, the same thing holds true when it comes to diversification. If you have money allocated in different asset classes, for example, I have some in cash, I also have some in the real estate market, but I also have some in the stock market, or perhaps in some precious metals, whatever it may be, as long as you're well diversified, then you have nothing to worry about. Now, I'm not necessarily saying you can't take the strategy in terms of allocating a little bit of more of your wealth or investment in and holding it in cash, so that way you have the opportunity to buy up some cheap real estate. All I'm saying is that you shouldn't necessarily put all your eggs in one basket. I just want people to consider this, that if you were to have $100,000 and you held it for a year, just hoping for the real estate market to collapse, and then after a year it turned out it didn't, you wouldn't necessarily be too upset. You would be a little bit disappointed you didn't gain any interest on that $100,000, but at the end of the day, you wouldn't be too upset. But now consider this other opportunity where you have $100,000 and you tie it up in some asset and it's not necessarily as liquid, and the real estate market does collapse, and now you don't have the funds available to buy up cheap real estate. You probably would be very upset, just like how people look back on 2008 and wish that they had taken the opportunity to buy up some cheap real estate. And I think that kind of relates to this whole idea of FOMO, or fear of missing out on investment opportunities. And I think that's why people tend to kind of brag or even comment down below or whatever, just talking about, oh, I can't wait till the next, market crash so that way I can buy up cheap real estate, is because they're holding too much money in cash, hoping and kind of banking on this opportunity. But it's kind of no better than just banking on, stock picking or something like that, which once again has been proven time and time again It's better to diversify and have a well-rounded portfolio than just to put all your eggs in one basket. Now, what would be some of the potential clear indicators that would show that a potential real estate collapse is about to happen? Well, the first will be just looking at your local area, because real estate markets tend to be very localized in terms of whether or not there's a crash or whether or not, in 2008, for example, there's plenty of real estate markets that didn't necessarily get impacted too much, but at the same time, they don't necessarily appreciate in value as much either. So they have less potential downside risk, but they also have less potential upside opportunity as well. So looking at your local real estate area and just seeing, are homes for sale staying out there on the listing for 5-10 weeks at a time, or are they staying more for 2 or 5 days, or are they being listed one day and then the next day it's already gone? If that's the case, then you have a very liquid type market. These houses are being put up for sale and then they're finding a buyer right away. Now, if you don't necessarily see that too much, then now that's something to worry about, because that means that there's not enough buyers to meet that supply, which may end up making sellers kind of compete for different bidders. So what they're going to do is they're going to compete on their price. They're going to drop down their price. Now, another potential indicator that's somewhat related is the supply of homes. We care about how many homes are actually being listed and out there in the market. But at the same time, we care about this only in relation to the demand of homes. So for example, you can have a real estate market that has, a local area that has 100 homes listed versus another area that has 50 homes listed. Now, everything all else being equal, you obviously would want the market that only has 50 homes for sale. But I'd rather have a market that has 100 homes for sale being sold, in 1 or 2 days time span than a real estate market that only has 10 or 15 homes for sale, but yet they're on the market, they're listed for, years at a time. That's obviously kind of a bad sign. So what I'm saying here is that sure, the supply of homes does matter, but it matters if the demand is meeting it or not. Now, another potential indicator to keep an eye on is interest rates. So interest rates, this is definitely one of those variables that has to be considered kind of under a microscope. So there are so many different variables that affect home prices when it comes to the real estate market. But interest rates, if everything else were to stay the same and you were just to raise interest rates, then that would cause people to kind of only be able to afford cheaper homes, right? If I'm going to buy a home and I'm interested in a $300,000 house and interest rates rise, then I'm probably going to tone it back a little bit. I'm going to buy a $250,000 house. So that's kind of how interest rates have this inverse relationship in terms of the real estate market. As interest rates rise, real estate prices go down. As interest rates drop, then real estate prices usually go up because now more people on the market buying a home. Now, once again, this is all things else being equal. If you can control all of the variables, that would be true. But that's why you see all these articles all the time where you see the interest rates rise just even slightly, and then everybody begins to panic, says the real estate market is about to collapse, there's bad signs. Now, it is an indicator, but once again, it's just one indicator of many. Now, last potential indicator I want people to be aware of is any type of major policy changes. I actually talked about Joe Biden's first-time homebuyer tax benefit that he may potentially pass, and one of the things I mentioned in that video is that most likely that type of policy would only be passed if real estate markets start to kind of get a little bit depressed and they start to drop a little bit, because this is a good way to kind of boost up and prop up the real estate market so that way we don't fall into some kind of major recession. Now, obviously, from a policymaker's perspective, you wouldn't want to use this tool and then have real estate prices collapse. You want real estate prices to kind of struggle a little bit and then use this policy, because once the policy has been used, it's kind of spent. It's really hard to kind of implement two of the same type of policies. So that's one of the things to keep an eye on, that if this policy is being talked about more often, then that's going to be a good sign that either it's expected or that we're already in a situation where real estate prices are starting to drop. So I wanted to go back to this idea of inflation and how that relates to real estate prices. So one of the things a lot of people like to talk about is how the consumer price index or inflation, those different metrics, how they relate to real estate prices, and that in general, if real estate prices outpace inflation, then eventually real estate market prices are going to have to collapse back and revert back to the same rate of inflation. So what I mean here is, if after a 10-year period, if you had $100,000 in, let's say, the year 2000, and then in 2010, that $100 would be worth $105 because of the rate of inflation, then real estate prices, once again, going back to the year of 2000, real estate prices, if you had bought a home at $100,000, should kind of be on pace with that inflation. So after 10 years, that home should, in theory, be worth $105,000. But here's where it kind of gets tricky, is that usually it's worth a lot more. So usually after 10 years, that home value is probably at $120,000. meaning that what people kind of predict is that there's going to be a market correction of about $15,000. Now, does that always play out? Not necessarily. Now, this is an important graph to kind of keep an eye on. It may seem daunting at first, but I'm going to break it down and simplify it for you. So what we see here is a home price index, which basically just means it's valuating the national average of homes and kind of making an index out of it. And let's say that the base year here, for example, is 1990. To kind of simplify in how we think about it, let's say in 1990 this home was worth $100,000. Then by the year 2021 or so, that home would be valued about $300,000. Now, this does have inflation built into that cost of that home. So if you were to back off that inflation and kind of adjust for inflation, basically you can kind of assume that inflation is zero, that you could have the same dollar worth in 1990 would be worth the same in 2020. Now, once again, that's just kind of theoretical. So that home that's worth $100,000 in 1990 with no inflation involved at all, that would mean in the year 2020, that home is valued at $150,000. So as you can see in the year 2012, you can see that home prices actually collapsed back to that 100,000 base price. So basically what it's kind of saying here is that home prices will collapse all the way down to kind of where inflation is basically irrelevant. Now, here's kind of the important thing I think a lot of people have to understand is that you can have asset classes outpace inflation permanently. Basically, if something provides more value than what the dollar would be worth, and that has a permanent effect and a permanent impact, then you would expect real estate prices to outpace inflation every single time. This is really key for people to understand that there are asset classes and things that can appreciate in value that outpaces inflation permanently. And basically what I mean here is, let's say we lived in a world where inflation was irrelevant, that the same dollar 30 years ago was worth the exact same today. So let's say that 30 years ago, people didn't necessarily care to buy a home. They didn't necessarily value that at all. And then move to today and people value living in a home significantly, then you would expect real estate prices to appreciate in value and go up in value regardless of inflation. And it would go up permanently. People would permanently, value buying a home more. The same could be argued the other way. Let's say 30 years ago, people really value buying a home, but let's say nowadays there's some kind of shift in society where people start to not necessarily care about living in a home. People value renting and being able to travel. People have like kind of communal type living situations where people, have a shared economy type living in someone else's room or living in an Airbnb type situation. That would cause real estate prices to permanently decrease in value. Once again, assuming that inflation was completely irrelevant, real estate prices can change. So I just want people to kind of keep that in mind, that are there kind of these other market factors, these societal market factors that have shifted demand permanently to justify an appreciation for real estate prices? Let me know down in the comments if you think a real estate market crash is likely or not, or how you plan to benefit from it. I just want people to consider that every single recession is a shift in wealth. Sometimes it's the rich getting richer, but in some cases you can have millionaires overnight, people that were completely broke becoming rich because of a recession. So I just want people to consider that there's plenty of opportunity, but there's also a lot of potential loss as well. If you gained any value at all whatsoever from this video, please consider giving this video a big thumbs up. It helps promote my channel and helps this video get to other people. I definitely put a lot of effort into my videos. I try to provide as much research and as much quality content as possible. If you appreciate that video at all, or if you appreciate that at all, please consider subscribing to the channel. If you like personal finance, real estate, or if you have requested topics, please comment down below and I'd be more than happy to respond.